All right, in this video I wanted to cover entity classification elections and whether you can elect to be treated as a trust or perhaps go the other way. If you set up a trust arrangement, can you elect to be taxed as an entity? So let's get into the rules, some of the 8832 basics, and then we'll see where we land here. So under federal tax rules, an eligible entity is a type of entity that can file an election to be taxed differently than its default treatment. Right, so eligible entities include certain foreign or domestic entities, and you can file this 8832 to change your tax treatment. So, very simple example here, we have an LLC that's formed as a Delaware entity. It's got 3 owners. So under the default rules, this is a LLC taxed as a partnership for federal tax purposes. That's the default treatment. The LLC can file an election to switch its tax classification to a C Corp. Right, if it files an 8832, if the election is approved, the LLC is now taxed as a C Corp, and it files a 1120 instead of the Form 1065. Right, so that's a common fact pattern, particularly with LLCs that have non-U.S. owners. They often make that C Corp election. So eligible entities can be either foreign or domestic. But it is very important to note that some entities are per se corporations and can't alter their tax classification. If you look at the 8832 instructions and the Treasury regs, there's a long list of entities by country that are per se corp. So if you have one of these entities, you can't elect to treat it any differently. So you've got to leave it as a corporate tax status. And the same applies with some U.S. companies, right? If you've got a Delaware C corporation, you can't file an 8832 to treat it as a partnership. It's got to be a corporate entity. You might be able to file an S election, but you can't make it a partnership or a disregarded entity. So the back to the question at heart here is, can a business entity elect to be classified as a trust? Short answer is no, not really, right? So the Form 8832, if you look at the election form itself, there is no option to elect to be treated as a trust for federal tax purposes. So there's only 3 options, right? You can elect to be classified as an association, taxable as a corp, so that's a C corporation. You can elect to be classified as a partnership, or you can elect to be a disregarded entity if you have one owner, right? So you've got those 3 options there. You can't really, there is no trust option. And so let's get into why that is. Well, a trust is not a legal entity type, okay? And that's why, right? It's just an arrangement. It's a legal arrangement between the settlor, right, which is the person that creates the trust and funds it, and then the trustee that manages the trust assets, okay? So the trustee holds legal title to the assets for the benefit of third parties, right? So the beneficiaries. There is no legal entity type when you have a trust. And so that's why it can't make this election, because it's not a business entity, right? So it doesn't qualify as a foreign or domestic eligible entity. And it's very clear here in the regs. So 301-7701-2A provides that a business entity is any entity recognized for federal tax purposes that's not classified as a trust. Okay, so that's the key there. If you've got a trust arrangement, it's not a business entity, so it can't elect to be taxed as a business entity. Now, here's the one catch to all this. It is possible to have a trust that might be taxed as a business entity, but it can't necessarily elect that. So it's a bit of an odd kind of, I don't know if you want to call it a loophole, but so for example here with a partnership tax structure, if you have a business trust arrangement, in this Treasury Reg 301-7701-4B provides that a business trust arrangement is not going to be treated as a trust for tax purposes, but instead it would be perhaps a partnership if it had multiple beneficiaries. Now, why would that happen? Well, trusts are created for the preservation of capital. They are not supposed to be engaged in any kind of business activities. So if you have a business trust arrangement here, you have a trust that was created with a profit-making business motive rather than that preservation of capital. And so because the intent and principal purpose of the trust is to be engaged in business, you don't get trust treatment. Now you have to look to, well, how would this be taxed as a business entity? So if you had a trust with more than one beneficiary, it's basically going to be taxed as a partnership for federal tax purposes. There are limited kind of circumstances where it could be taxed as a corporation or maybe even a disregarded entity. But the idea here is, if you have a trust that was set up without a preservation of capital motive, but more of a business for-profit type motive, you're not filing a Form 1041, right? You're not treating this as a trust. You are going to be treating it as a business. So, but again, you can't elect that, right? So you're just looking at the terms of the trust arrangement, and who's managing the assets, who are the beneficiaries, what is it doing? You're looking at all those kind of qualitative factors to determine how it should be taxed. So again, you can't elect anything on the 8832, but if you really dive into the trust arrangement and you find yourself in this bottom section here where you have perhaps some business activities going on, it's probably going to be taxed as a business entity and not a trust. So, okay, so that covers it. I hope that was helpful. If you have any questions, please leave me a comment below. And of course, I always appreciate a like on the video. Subscribe to the channel if you haven't already. And I look forward to seeing you again soon. Thank you.